Hey everyone, welcome back to Mangosteen. In this episode, we're going to cover off why capital gains tax, or CGT, is rigged. Capital gains tax is mostly a scam, and we're going to talk about why, because it's taxed on a nominal basis, and we're going to talk a little bit about what a nominal basis is. And on this basis, CGT represents asset confiscation rather than a tax on a real gain. So we're going to talk about that in a bit of detail as well. So as you can see from this graph, I've used it in a previous rinsed episode, was the return on a house price over 5 years. And if we assume that the interest cost and maintenance equals approximately the rental income, then we can just talk about the pure gain on the capital valuation of the house or the price of the house. And if we say, hey, look, hypothetically, we bought $1 million house with a 20% deposit, and then we held it for 5 years, and we had like a 6% annual house price growth rate, we'd have something like a $1.38 million house, and that would represent a nominal gain of $376,000, right? So that would be a purely on the raw currency figures, a $376,000 gain. But on a real gain, if we were count or adjust for inflation, that gain might reduce to something like $150,000. And if we were to measure the gain in terms of monetary inflation, we would have probably made a negative $80,000 approximate loss, or maybe $100,000 loss. And we can see that through accounting for monetary inflation, which we will on the next slide. But basically, if we were to sell this house and there was a capital gains tax, and let's say it's 30%, then this house would attract $112,000 tax payment, which would represent something like 8% of this $1.38 million figure. The house has not outpaced any money creation. The capital appreciation is purely reflecting monetary debasement in the economy. The property on a real basis is worth the same as it was 5 years ago, right? It was a property that we bought, you could live in it, and its real valuation was that. And on a real basis, maybe some depreciation has occurred, things have worn down in the house over the last 5 years. But the house is the house, right? The only thing that could possibly make it worth more is if there was suddenly some hyper, valuable aspect, like a school was built nearby or a train station or something like that. But assuming that that hasn't happened, the house really is the same as what it was. Now, basically, the government has said, hey, we've increased our money supply, the value of your house has gone up, and we're going to take a 30% tax on any gains you've made, but really you're just 8% poorer. You're just giving up 8% of the property's value to the government when no real capital gains have been made. A true capital gain would be you own a house, you've traded it, and in that time frame, like maybe the monetary debasement is negligible, but the house has gone up materially because of other aspects. Maybe you've added value to the house, maybe you've done work to it. That would be where you'd have a capital gain, where you're making a gain that does in fact outpace money creation. That would reflect capital gains. But really, all we're doing at the moment is trying to counter monetary inflation, and for that, we get confiscated. It's more of a wealth tax. This capital gains structure is a wealth tax. So here's that supporting analysis that I sort of discussed earlier, where you can see the nominal returns of houses. They are all very positive, and everyone's very happy by the return on their houses by all these sort of countries, these sort of Anglosphere countries. But when you adjust them for money supply or broad money supply, all houses have actually gone down over time, and they represent a lower share of the money supply in the 90s than what they did in the 2020s. And that is a byproduct of the fact that we have gotten better at building houses. Houses have actually become more plentiful on a per capita basis. And if you go to my Rinsed Part 1 series, you can look a lot more into the detail around that. I talk about how housing scarcity is really not as true as what people would like you to believe. And really, house prices really just absorb monetary inflation. You can see it really clear in these graphs. This is just raw housing price index over the last 30 years. And here we've got that same index, but when you adjust for that money supply, and you see that houses, in fact, don't keep up with that, and houses don't appreciate when adjusted for an increasing money supply. So again, a bit of a short and sweet episode today. If you found this interesting, I would recommend checking out my full Rinse series. It goes into a lot of detail and forms the backbone of the sort of ideas that I have that create these sort of one-off videos. So jump into that. I've put a link on the right there, so you'll be able to easily access it. Cheers. Thanks, guys.